Jeffrey Sherman joins me today. Jeffrey is the Deputy CIO of DoubleLine Capital, which manages about $92 billion. He also has a podcast called The Sherman Show and had me on as a guest about 3 years ago. Jeffrey, I'm glad you could join me for my podcast today.
Yeah, well, thanks for having me, Alex. It's good to see you again. And it's good to do the other way around.
I agree. It's fun both ways. I always like to start with background. I feel like it gives us a little peek into who you are and how you think. And you have an interesting background. You studied math and originally planned to become a teacher. What changed and why did you ultimately choose the world of investments?
It's an interesting kind of question because when I was in undergrad, I kind of thought, hey, I'd like to be a math teacher, probably high school level, maybe like be a coach or something, just have a lifestyle like that, try to help people and try to impart some knowledge and skills along the way. And then as I was forced to take a class, which I appreciate the university for making you do that. And the class was one where you had to go on site to the schools and observe teaching and everything. And man, high school wasn't what I remembered, just in that short period of time of graduating like 3 years prior. And so all of a sudden I thought, maybe this isn't for me, just seeing kind of the energy and the lack of attention and things. And so I kind of reassessed and said, I think I want to go more into academia and let's try to get a PhD. Let's go down that path and ultimately maybe become a college professor, right? Because I feel like at least those people are trying to learn a little bit more and everything. And let's give up the dream of coaching or whatever and just go ahead and focus on that. So I started a PhD program in applied mathematics. And along the way, I'd studied a fair amount of statistics because I had this like aversion to physics. Just never really cared for it. And that's why I didn't become an engineer. I really just kept studying math. And a lot of times the applications were statistical in nature, either probability. I mean, there's a lot of fields in mathematics. And so ultimately, taking econometrics and a lot of advanced statistics, I ran into finance and there was a financial math kind of major along the way. And I discovered that and I saw that, hey, you can get a job in finance and you can make a lot more money than becoming a professor. And so ultimately, I decided to pivot, as the young folks say these days, right? And I kind of changed the direction and I dropped out of the PhD math program and ended up transferring universities to get a degree in financial engineering. And so, from there, got an internship, started working at my first job at TCW. Just right after that internship, got on a team by a gentleman by the name of Jeffrey Gunlock. And ultimately, when he left TCW, I joined him to join DoubleLine. And so, I don't think there's any one real career path. People talk about, oh, yours is unique, it's different. We all are a function of our own experiences. But I think what was helpful with that is, when I was a grad student, I was teaching as well. And so, being a teaching assistant and teaching class and writing lesson plans and things was very interesting to me. And so I think it's been helpful in the role that I have these days as well, because there's something rooted in that ability to convey concepts, right? And as a math teacher, for instance, what I learned along the way is some people are visual, some people are oral, they need to hear it. Some people are very written, they have to write things down to understand it. And so having these different perspectives or approaching problems differently or trying to draw a picture to solve an algebraic equation, things like that, I think were very helpful for the job I have today, because ultimately we're trying to convey concepts to people. And you're trying to distill things down. And what I say in math, we always think about principal components, right? Break it down into its easiest pieces and build up those pieces of things. And so in finance, always the principal components, whenever we're struggling with a problem, we always just say, follow the cash flow, right? So if you can model the cash flow, you can model the security, you can model the investment, you can model the analysis. And so I think some of that is rooted in that kind of formalized kind of teaching. And so that's always been something that I enjoy. And I think it's been something that's really helped with my career as well because we have interaction, right? I've done client reviews with you, Alex, right, where we talk to some of your clients, and so the question, the response I would give to you would be different than probably someone else, right? And it's trying to understand who you're talking to and trying to break it down into those components that people really understand. And so it's a long-winded way of saying that I still kind of feel like I have some of that. Over the years, I taught at the CFA review program that they host here in Los Angeles. It's co-ran by USC and the CFA program here. And so I kept my hands in it at times, but as the responsibilities have gotten greater with the role, I had to kind of let some of that go. But I still feel that on the trading desk and bringing in new analysts and new folks is the ability to continue to kind of hone that teaching skill as well.
One thing that you mentioned that's a little bit unique is you've essentially had one job since college. You first at TCW in 2001, and then your team left and to start DoubleLine in late '09, early 2010. And so what is it about the organization and the team you've been with since you graduated school for 23 years that has kept you there and has fueled your success?
Yeah, well, I think what it is it's camaraderie at the end of the day. People would talk about kind of a family component or a friendly component. And, the people I work with are my friends too. Yeah, we have that family component, but there's times you're going to have a little bit of disagreements, right? You're going to have a little rivalries at times. But there's something about the team that we have around us that it's always been appealing to me. And it's people I grew up with. Some were mentors that, some have retired since then. There's some that are, my peers today that, we've worked together for those entire years of my career. And then we have a younger generation that we are going to hand the reins off to as well. And so as I think about kind of the way that we've organized the team, it's always been very team focused. It's always been there's a collective success. And we're not a traditional like Wall Street trading firm where it's my desk versus your desk or this is my idea. It's our idea. And that is something that I've always liked. Like I am competitive in nature, right? A lot of us are. But I do feel that having that camaraderie and that collective success, it feels very good. And there's times I'm wrong and the team is right or others are right. And I'm just as happy in those moments as well. I try to think about what did I miss or something else. But I think it's that ability to, you trust one another, you trust them with your careers, you trust them with your lives. And again, we've all kind of grown up around each other. And so I think there's something about that is very valuable. And so, we have hardships, we have trials and tribulations. As the athletes say, we go through our adversity. I'm like, you were playing a sport. I don't know how adverse it was, but okay. I always crack up at that word.
It feels adverse when you're playing it
It
sometimes.
is. And, look, markets are adverse. They're never friendly to you. No matter when you look back at a track record, you're like, oh, that year was so easy. It was never easy in the moment. And so I think there's just something about it where, it's a bunch of people I believe in. It's people that we've worked together. We're constantly striving to improve ourselves, improve the product that we're putting out. And, there's just that belief in one another. And I think the quintessential word is camaraderie, right? And it feels like you're not going to work when you have those kind of environments. Yeah, there's days we have to, you got to put on the uniform and go in and, you put in your time. But in general, it's something about, well, how are we going to solve this problem today? And that's what's very interesting about our business in general. And, having people around you that share those same kind of beliefs and want to be better every day, it makes you better as well.
Well, one of your partners is Jeffrey Gunlack that you referenced earlier. You've been working with him for over 20 years. Are there any key investment lessons that you've learned from that experience?
Well, absolutely. One is that the market will humble you. First of all, you will make mistakes. You'll make them multiple times, and you try not to make them 5 or 6 times. It's also teaching to have confidence in your abilities. It's also having the ability to defend a position, right? Defend an idea. You don't come with something half baked to Jeffrey Gunlock and say, well, I kind of think this may work or something. And, you've got to be pretty blunt and direct and be able to convey the idea. And so I think one thing that I've learned, and again, others around the same team is that it's conveying that idea as concisely as possible and be ready to be challenged on the pitfalls, which are good, right? And I think the other thing I've really learned from him too is trying to realize that every portfolio has a hole in it somewhere. And we always are looking for what is that hole? Where does this go wrong? And if it goes wrong, the one thing I've learned really from him is that you don't want to blow up, right? So things can go wrong, but what does that mean? Are we out of business wrong? Like a hedge fund, they're levered and you have these problems. Or is it, okay, you have a little bit of underperformance, but you can reconcile it, you can get through it. And that comes down to sizing, risk management, and there's a lot of lessons around that. But I think it's, one thing that I've tried to inherit from his style was, believing in the team around you, encouraging people to bring ideas, again, trying to also play that devil's advocate at times. And so I think that's something that has been really good with the team in general. And it is because of the leadership he brings to our overall organization.
Yeah, all of that resonates with me because when I look at investments from my side, if I can't see what the risk is, then I get very worried. If it looks like there's no way this can go wrong. That's most concerning to me because if you do get downside, it's going to be a surprise.
And usually, when you think that, you enter the trade, and then the next day it goes wrong, right? So you get humbled very quickly, and that's the other thing. I think one other lesson too to a lot of investors too is, the hardest trade to ever do is to unwind a very successful trade. So you were right. Let's say you bought Nvidia, 5,000% ago, which was what, like 2 weeks ago, probably by the time this gets out, right? But you did that. It's always great to look at your statement when that happens, right? It's self-reinforcing. But what happens when you're now only up 4,000%, right? You're still up. It still feels good, but maybe you should have been paring back risk. That means you're down 20 on the trade now, right? And so one of the hardest trades to ever do is something that continues to work. And maybe you should be paring it down and moving that. That's the risk management component too. I think it's a lesson that every investor has to learn at some point. And again, it's not just about cutting the losers. That a lot of people are like, oh, we need stop losses and all of that. Also, it's the other side. It's trimming some of the winners, recognizing gains, and moving on to understand that there may be new opportunities.
And you started your career right in the middle of a bear market, at least for equities. Did that have some major influence in the way you think about risk and just your whole mindset?
I think so. I've noticed this over the years. So I'm really glad you brought this up, Alex. And I feel that there is something about the vintage of when you start shapes some of how you are an investor. And, it's because of the markets you were in. And so fixed income was a good market back in 2000 when I started in the business, right? Or 2001. And, obviously equities were bad, had a rough little patch there, especially in 02. But then, it was a good bond market for a while. So, when I took risk as an early investor, especially in my own accounts, like I liked high risk fixed income, right? Because it was double digit type returns. It was double digit yields. Like, and those things really resonated with me. And then we got mired post GFC and just things weren't as good. But I noticed this at the people who started a few years after me. They love risk. They loved equities. And I couldn't really understand it at first. I'm like, but why don't you say, well, 80% is not enough for me. I need the tens. And it's just an interesting dynamic. And I've watched it throughout my career. And I see that with, the younger generation who came in during the crypto booms, right? And they have this propensity to take those type of risks, which I'm probably a little more averse to. And so I'm also a big believer in the idea that the risk tolerance isn't a function of age. And that's a controversial topic to a lot of folks, but your risk aversion is your risk aversion. And, look, if you're trying to buy a house and you're saving money and you're 30, do you need to be 90% equities? No, you need to save some of that cash too. And so, ask anyone who's, generated a magnificent amount of wealth, they become more risk averse, right? They made their money. They probably did it in a high risk seeking manner, but they're not usually looking to replicate that. And so I think we're a function, again, I said this earlier, a function of our own experiences, but some of that has to do with the markets you grew up in and you've been around and you get some familiarity with them. And so, yeah, it's a lot harder for me to buy a stock market when the multiples, in the 20 handle, right, on earnings. I just cringe when I look at that, especially when I look at the bond market where it is today. So I think there is a function of that where you're taught it is the experience, and there is something about that vintage there, which is why you need investors around you that have different experiences, different vintages, and have the ability to bring in a different view on risk.
Because in some ways it is an accident when you happen to get started, when you were born, where you were born, etc. So that shouldn't overly influence your thinking, but we're humans and we're prone to that.
Yeah, it's true. And that's the whole thing too, is that, my generation, along with you, like we're Xers, right? We're Gen Xers. And I'm like, there was nothing more privileged than being a baby boomer. Everything they did turned to gold, right? I mean, yeah, they lived through some inflation early in their lives, but the housing market has done like a 10x for them. Look, they've had this great social security program. I mean, a lot of the things that have happened, and they had the big boom of the 80s, like they've seen capitalism at its finest. I mean, you talk about peak career, most people, and again, not everybody was able to capitalize on it. But again, it's just the genetic lottery too, right? It's how you're born. And so I think that's the thing of just trying to make sure that you're not thinking that way. And I've ran this issue lately a lot, Alex, when talking to clients, like, well, doesn't everybody own money market with their cash? And I'm like, you got to remember the circle you traffic in. You talk to advisors, you talk to wealthy clients, right? You talk to institutional people, you talk to everyone with financial literacy. And that's the difference, is that not everyone has that same component. And so there's a lot of people whose cash that's listening to this podcast are sitting in an account that's earning basis points today, right? Where you can go buy a money market fund. It may not last for much longer if the Fed's going to cut rates, but they yield more than 5% today. I mean, that's very attractive for people, and just not knowing that. But that comes back to the kind of the educator in me that wants to tell people about it. And so when my friends come to me, a lot of them are engineers. As I kind of said, I was the one that kind of copped out and just did math and didn't do the engineering. They asked me for ideas, and that's my favorite idea over the last 18 months. So just take your cash and put it in money market. And so, they're expecting to get some hot stock tip, and that's what you get from a bond guy is go buy a money market fund.
One thing that I've noticed with people with a quantitative background is they tend to overly rely on historical data. And I know you think in probabilistic terms. Would you talk about that mindset?
The thing is that when you ask someone what's the probability of something happening, the easiest way to do it is go in what I'll call the frequentist approach. And what I mean by that is you go to history. How many times did it happen? And therefore, that's that you take the number of observations times it happened divided by the number of observations. And that's the frequentist approach. That's how frequent it has happened. Probabilities are very difficult. And I read once that people really only understand 5 probability numbers. And I think it's a very, very good way of thinking about it. And anybody that gives you one of those 5 different numbers, they better be very sophisticated to get there. And so I'll give you the 5 numbers, Alex. This is a secret sauce. 0. That means it will not happen. I think we know things like that, there's 0 probability. The next thing that people will know is 1%. What you're saying, there's a chance. It's not very likely. It's probably closer to 0, but you think there's a chance, so you call it 1, right? The other book into that is 100. It's going to happen, right? Things are going to happen. In markets, there's never 100, right? There's the 99, right? Say it's going to happen, but there's a chance. And if I'm wrong, that's why you'll never hear a probabilist say 100. They'll say 99, right? So those 4, I think, are the bookends. What's going to be the 5th one? 50-50. Right? It's the 50% chance because it's the coin flip. That's kind of the basics, how we teach probability. And it gets much more difficult in between there. So I had a guy on the macro team the other day say, I think there's between a 20 and a 25% chance of this happening. And I said, well, what's the difference between 20 and 20? And then, we got in this really philosophical argument of 20 versus 25, right? But the thing is that, okay, in probability, there's something called the complement. The complement is the opposite of that. So it's 20 and 25. So give me what the other 75 to 80 is, right? Well, then when you start to break that down, it gets harder. So the probability stuff is like, again, you're just trying to say, okay, how do we weight things? But you have to have some guide. And the frequentist approach is where a lot of us would start with it. But then you have to ask yourself during the observations you got, whatever you were looking for, what is that environment like? Right. And so this is where it gets very complicated. You can say, okay, it only happened in 5% of my observations, but you have to go back and look at those observations and say, okay, what was the environment? What was the inflation regime? What was the stock market doing? Where are the multiples at? Where was valuation? And so that's another way of thinking. If you find a lot of similarities in those, then that gives you a good example of saying, maybe I should do this kind of what we call the Bayesian approach and say it's going to be a higher probability, right? So you try to think in it, but it's more of an art than a science when it comes down to this stuff. And so this is that where you say, okay, I have this inclination where the probability is, but now let me look at the complement. Well, if the complement's greater than the probability of this happening, how do I survive? This comes back down to the risk management side. So and if you can, again, trying to break it down to components, if you could start doing that a couple times, that's how you can end up with your 20% chance of this and 35 of this. And because you're breaking it down into different pieces. But I think, probability is not mathematics. Probability is its own branch of math and it's its own branch of study. And it gets difficult by about the third week of a probability class. It is out there. And to anyone that doesn't agree, you are gifted in probability. It gets very difficult real quick. And so I also think that probably it's blended too much into statistics and that, people think they're very similar. Probability is a very difficult form of mathematics. And I think those that have it have an extreme gift. And I'm not great with it. But, again, if you can break in those pieces, like I said, it can be good enough to help you in a forward thinking basis.
And one of the hard parts is it's hard to assess whether your analysis was good or not. Because if you guess the 40% odds of something happening doesn't happen, you were right in some ways. And if it does happen, you were also right. So how do you know?
That's exactly that. And then now we get really crazy and outlandish thinking. And this is what guys like us sit around and talk about when we're at the bar, right? We don't talk about what's on at the sport. We're talking about this idea. But if something has a 5% chance of happening, right? Okay. So, there's a 1 in 20% chance of it happening. You're like, okay, well, it's probably not going to happen, right? That's the compliment. The compliment is 95%. But then how come someone gets some freak disease that's like, it's 1% of the population, or it's a very, it's 20 basis points. It's because it feels, if that's you that experiences that and it's a negative thing, you think, this is the worst luck in the world, but we should expect it, right? And it's just like the lottery person that wins it. They're the luckiest person. No, someone is going to win it ultimately, right? It's just who it is. And so you have to remember that, especially when something bad happens to you, and it's a low probability event of something bad happening to you. It's just you got to roll the dice that it didn't go in your favor that time. And so it doesn't mean that the probability was 90% of you getting that. It just you unfortunately got the bad luck of the draw.
As you know, I've always been a huge fan of balance, and I know you have as well. Would you share your general thoughts about having a balanced approach to investing?
Yeah, I think balance comes down to it's not like the 60-40 stock bond portfolio when it comes to balance. It's trying to balance out risks. And again, this comes down to this concept of survivability, right? You want to make it through the environment. You want to make it through the week, months, whatever it is. Your horizon is what you really want to make it through. And so the balance approach is saying, okay, I have inclination. How strong of conviction do I have? Look, I've had people around me that have the greatest conviction in the world and have been absolutely wrong. Now, were they right? Maybe. Again, you got the bad draw again, but also you get this idea that, the balance helps you survive. And so what I feel, if you think about investors' track records, and this is something that I've kind of gleaned from Jeffrey Gunlock as well, is that if you're good enough, every day, right? Think about an athlete that's good enough every day. You're not going to be the superstar, but you're going to have a long career. Investing, it's the same way, right? If you're good enough, if you can outperform that benchmark by just a little bit every year, well, guess what? In 10 years, wow, if you didn't have these ups and downs, these big swings, you didn't blow up along the way, you didn't have this big donut hole in your portfolio for a while, then you're going to have a pretty strong track record because people tend to gravitate that. They don't manage the risk, they let the risk manage itself. And so it's that idea of letting the winner run. there's nothing wrong with letting the winner run if the winner keeps winning. And you have a thesis for why it should keep winning and it should keep doing it, especially in the equity world. And so in the bond world, if we buy a good bond, you know what we get back at maturity? We get back par, right? So at the end of the day, you just got to be good enough. Just make sure that that company or that security or that asset type, it survives. And so the balance is that you want to have different things that work at different times. Investors love to look at their portfolio and see everything up, right? I mean, you would agree. You don't mind that, right? I mean, it's great to do a client review. Yeah, everything's up. We're so brilliant. But if everything's up, you have some form of correlation. You may not be that diversified, right? You don't have some balance in there. And so, and then you also know when you've been in there and you have 30 line items in the portfolio and 29 are positive, the clients go, what was this one, right? What is this one that was negative? And I'll say that's the diversifier, right? But that's the idea, is that you want the things to work together. And you see, I'm using my hands to do all this. And like, it's a multi-dimensional puzzle. And so the more things you can bring into the portfolio that help offset risk or at least diversify them is a good thing. Now, we've kind of used a phrase around the DoubleLine trading desk that we call it risk integration. And so I don't like to hedge. Hedge costs money. The sayings, there's no perfect hedge except in the Japanese garden, right? And so if I can find things that offset each other, but also pay me and have a positive expected return, those are things I want to have in my portfolio. Said in mathematical speak, things that have low correlation, right? Or, have negative correlation. They're going to be different. If you buy two negatively correlated assets, one should go up, one should go down. Maybe not every day, but through a period of time. So you're guaranteed to have a loser. But the portfolio can be much more resilient. And that's something that I've tried to teach my younger quants, and they're not so young anymore.
And then how do you think about balancing your thinking? So, and what I mean by that is if you're a quantitative type of person, maybe you want to spend more time studying fundamentals. I always think it's helpful to be a student of history so you can balance your actual experience with all the other things that have happened in the past, understanding behavioral biases, understanding your own biases. Would you talk about how you think about all that?
Yeah, I mean, that's a lot. I think that, the easiest thing to do is find opinions different than yours and read them and try to figure out why their argument makes some sense. Don't come in with that inherent bias. I'm right, you're wrong. I'm going to read yours. I'm going to poke every hole on it. Actually try to find out why they could be right or why they're absolutely wrong, right? But make sure you're listening to the other side. Tell me where I'm wrong. I like this idea. Tell me where it goes wrong, right? And is that a risk we're willing to take? So I think that's very important, especially when you're doing research. In research, the inherent thing is to really find a confirmation bias. Read someone who has the same opinion as you, go out there and read their stuff and say, yes, see, now it's exactly right. This is why I had this idea. I think it is extremely beneficial to try to read the other side. The behavioral aspect is exactly what we're talking about here, right? You're seeking like-minded individuals because it makes us feel good, right? We have this positive affirmation. It's reinforcing, and it allows us to, just laud ourselves on our brilliance, right? At the end of it. And so I think that's important. I think it's history to understand that, as you said, working with long data series, like going back and what's different about this market versus another one? Does it rhyme? And I know people like overlays, like I keep seeing it now, like here's the NASDAQ bubble. And if you take NVIDIA back 22 years, you overlay it, here's where we are. But is that really the same environment we're in? Is that really the same story to the single stock that it was for this overall market? And I think the answer is probably no. And so, the behavioral side is very difficult because, we always look for that affirmation. And look, the scoreboard is there every day in the investment business, right? Every day there's either a positive or negative experience you have. And, I think the worst part is when you have just nothing but failures. Right. And like the collective, repetitive success is great, of course. But those days where it's like, look, this is just not working. It's not, why isn't it working? And then the question is, do you get out of it now? Or is it about to work? Right. And so you have to kind of re-underwrite too. But the behavioral thing I think is important for any young investor and new to this to understand what we've done. And we talked about it, right? Like I have an inherent bias of my vintage of when I started in the business, right? I know that. So what do? I'm one of the guys that just goes and buys equities and just doesn't think about it. I don't ever try to trade it. I have systematic strategies that we use. I like all of those because they make sense to me. And I'm just kind of a steady buyer of those, right? Another thing I do, and it's probably where a lot of us are guilty of this these days, is I buy venture capital and private equity with a lot of my equity money. Why? I don't know what they're doing. I can't get in there and have an opinion about this stuff. And you know what? It tends to work okay. And I'm like, you know what? Let those guys do that. So it's also understanding your weaknesses and trying to play into them. But anything you can do to kind of round yourself out. And that's why I think it's always good to have, go have these dinners with a bunch of people and just discuss ideas. Don't get a bunch of people who all think the same thing and do that. Those are fun dinners, don't get me wrong. But it's always good to have someone in there. So I think that's what's helping bring in the balance. But in today's world where we can find news sources that are targeted to exactly whatever we're thinking. I'm not talking about left versus right. I'm talking about very narrow corners of things. It's much more difficult. And I think too many people they succumb to that. And maybe that's why we have a bit of the kind of polarization we have in some of these areas is because of that, right? It's like, no, I'm absolutely right. I know 18 other people on here that say I'm absolutely right. Our opinion is all that matters, and forget the other, 8 billion people in the world, right? So anyway, I think all these things are very important. History is a guide. There's a Buffett quote I like. Everybody loves Warren Buffett. One of my favorite quotes is from him was that if history was all there was, and I'm paraphrasing because I don't remember exactly, but if history was all there was to investing, the richest people in the world would be librarians. So let that sink in.
I like it. Let's transition to your outlook. Obviously, you spent a lot of time thinking about that. And let me start with kind of high level. If, as a bond investor, what do you think about the US and other major developed economies printing money and debasing the currency at unprecedented levels? It seems every day we get closer to a tipping point, and obviously it seems like it's not a problem until it becomes the most important thing, that tipping point. And are there signs you're looking for to try to get a head start on the market?
So to answer it very concisely, the answer is yes, I'm concerned because again, we're taught fiscal austerity. You're taught to, as a individual, I have to be austere. I can't spend more than I make, right? Or I just won't survive, right? Unless I've got good people around me to lend me money all the time for free. And so I think the difference that we see is that there's a lot of arguments of debt to GDP. Is that the right kind of measure? Because GDP is the assets. That's kind of how we think about it. But GDP is not the only asset. Is the unfortunate thing. Look around your neighborhood. There's a lot of houses out there, right? Those aren't in GDP, right? But they're assets, right? So that's another. I think the debt to asset ratio is probably a little bit better to think through things, and that includes financial assets. That includes the sofa that's behind you. It's everything. As you think about it, those are the overall assets. So I am concerned about it. I think it's been reckless. There's no semblance of trying to slow this down. And look, it's coordinated globally, which is why I don't think there hasn't really been a debasement of the US dollar, for instance, right? Because we're all pursuing similar kind of strategies. And so from that standpoint, it's not you said it best, it's not a problem until it is. And it's like it's the old like Great Gatsby quote, right? Like how'd you go bankrupt? It was like very slowly, then all of a sudden, right? And so what's the telltale sign? We all know what the spending is going to be, right? The Treasury told you that they're going to borrow 740 billion dollars in the next 3 months, right? That was the quarterly refunding announcement that came out this week. We all know that. What's the bond market do so far? It's rallied, right? Why? Well, there's something else driving it. So when it's probably too late. It's the slowly part we're in, and then the sudden will happen. And I'll credit my friend Jim Bianco on this, who's the economist out of Chicago, that has his own research shop. And he said it to me very nicely. It looks like the UK gilt crisis. It's that a policy comes out and the bond market pukes. And there was a lot of talk of this last summer. right? If you remember from that July to kind of like, late September, early October, every headline was about the deficit, right? Oh, the reason bond yields are going up, the untenability of this, the unsustainable nature. And that's not what happened in the gilts market. Yes, the 10-year went up like 140 basis points from the trough to the peak last year, but it happened over like 10, 11 weeks. That movement happened in the gilts market in days, right? So I think, and that was in response to Liz Truss coming out and saying, we're going to fight inflation by cutting taxes and doing more quantitative easing, right? To stimulative policies. And the bond market said, no, you're not. Now, you could argue that it's a tighter market. The pension schemes over in the UK, they tend to all invest in long bonds. Like they have gilt linkers, which is inflation linked long bonds. They do a little bit of leverage because of the shape of the curve. That's always been somewhat beneficial over the long period of time. What also another way of saying it, it's a crowded trade. Alex, you consult to a lot of folks here in the US, right? Think about our pension schemes that we call them pension plans. Scheme sounds dirty in the American language, right? But the defined benefit plans that are out there that are hedging this, what do they own? They own long treasuries, they own long corporate bonds, right? They're in a very similar position. So this idea that it can't happen here because we have a bigger economy, a bigger system, I disagree with. If that trade starts unwinding, it's problematic. And so I think that you'll recognize it from the bond market. I was on a conference call with some very well-known investors. Somehow they accidentally invited me. I don't think they meant to. And I was listening to them talk, and I won't drop any names. And they were saying, you know what? For our politicians to pay attention, the long bond needs to get to 6. And I was listening to this, and that's what's going to be held. That's the bond vigilantism, and they're from a different generation. They've been through the true bond vigilantism. But I kind of chuckled. It was early on the West Coast. It was like 5:30, and I'm still drinking coffee, listening. And I chuckled. And someone said, "What? Why did you laugh?" And I said, "Do you think any of our political leaders know what the long bond is? Have you looked at Congress lately, right?" And so, but I said, look, I respect your guys' opinion. It's just that I'm not really sure that happens. I think it has to be over a longer period of time. It has to hit the budget. It has to go through. And look, we just published a paper. One of our analysts on our macro team put something out about the estimates and how horrible it looks out there, and it will be a problem one day. And there's one way out. Well, there's not one way out. There's many ways out. The best way out of it, you grow your way through it. You increase nominal GDP by more than this, and it gets through it. So that is the answer. If we can't get there, then the answer is devaluation or it's inflation. And then there's the worst one of all, there's default, right? And I've heard this from our emerging markets team for the last 15 years. Like, well, the EM world, it's a better story. It's a secular growth story. And I agree with all that. And their financial houses are better. They're better at managing. I'm like, hold on. That I can't agree with. They're in a better financial position today, but they've also defaulted to get to that position. So I'm not here to say the US is defaulting. So please don't make that someone listen to this and becomes a headline out there. But maybe it is some form of jubilee. Maybe we just have to have some fiscal austerity and try to grow our way through it. So I don't know the answer, but I think you'll recognize the signs from the market. And at one point, the market will rebel, and that will change things. But so far, so good. But that doesn't mean we should keep doing it just because it worked.
Right. And you're talking more in nominal terms. So the 10-year treasury may start to drift upwards as the pressure starts to mount. But how do you think about real interest rates in that type of environment?
It depends on what the relief valve is. If the relief valve is the dollar, then maybe you still have decent real yields, but maybe you have negative real yields because it is putting pressure on inflation there too. And so that means that probably if you get that, then the nominals have to continue to rise, right? Because at some point, investors will say, why would I buy this worthless piece of paper, right? That doesn't even outstrip inflation. I'll just take my chances elsewhere. And so real yields historically, vacillate between the 1% and 2% range. That if you go back and you study kind of the series I grew up on back then was called the Ibbotson series, right? The SBBI series, stocks, bonds, bills, and inflation. And if you go back to that, it's kind of what you figure out. And then I kind of always use the post World War II era. I was kind of taught that there a lot happened during the wars and everything there. So that's kind of the way to think about the economy. But if you were sitting in the markets in 2020, and let's say you were getting to being a mature investor, you've been in the markets for 12 years, you'd say, no, real yields are zero because they were for that entire period. So I think what happened there is because inflation was so muted that people were comfortable. You didn't need compensation for that inflation premium because it didn't exist. But now we've seen it again, right? We've seen inflation again. So when you start to see some symbols, I think traders will trade it much quicker because now versus being a student of history, say, well, that just happened in the 70s and the 80s. Those crazies, what were they thinking, right? Well, it's got the gold standard. That drove inflation, right? So we have nothing to worry about. We all coordinate this 2%. Well, maybe that period was the aberration, the post GFC to the pandemic. And I'm a believer of that. I think these are more normalized markets. So I think investors are going to demand that real yield there. And we have it today. And I know the bond market's rallied a lot today on the day we're recording this. This is the day after the Fed meeting too. There's a little bit of weak manufacturing data that kind of continue the rally. But in general, I think that what you see out there is that investors aren't used to seeing these type of environments. And so just remember the age cohort that's come in, a lot of them had never seen rate hikes before, right? Never saw them, right? We used to joke about that in the mid-teens, right? Like in the 2010s, you haven't even seen a rate hike. What do you even know about, right? Now you see it. I'm like, I never saw 9% inflation in my career. Now I have, right? And so this is, again, a function of experiences helps you. But I think that under that scenario, I think, it's kind of like what do people do in Argentina and Venezuela? You buy stocks because they're nominally linked, right? At least prices are nominal, right? And so earnings can be nominal. So you may not be keeping pace with things, but there are things you want to tie that are tied to more nominal assets. And so I think that's part of it. And like real estate, right? I think you want to own real things in that environment. But in that environment, you probably don't want to own, the 30-year long bond.
Right. If we were to zoom out and look at the bond market and we look at the last several decades, so you had this extended period of falling interest rates. So you had this falling rate tailwind from the early 80s to the GFC. Then we had a decade plus of near zero or zero rates. And so do you view us in a new regime today relative to the last 40 years?
I didn't, well, I've lived through the whole 40-year bond bull market, but I didn't invest in it, right? I wasn't those, prodigies that were like 6 years old saying I was picking stocks or anything. I'll be honest, I never bought a bond until I was in my 20s. So I can't say I benefited from it. But the difference is, I think, is that, there's so much made of that. And it's easy to look at a chart and say that. But I don't know. I mean, I started in 21. Right. I watched that. I watched rates go down. Right. I mean, rates went down meaningfully in '03. I remember the agency mortgage market. I think the prepay speeds that year were like 80%. Like we got in this big refi wave too. Rates came down, but then all of a sudden rates went back up. So even if it's this 40-year bull market, well, it's great if you got the 40-year horizon, but you got to live through it. You got to invest through it. And so, I think what it is that I think we need to be a little more discerning now. And would you buy a negative yielding bond today, Alex? No. But how many people did 6 years ago? Right? I mean, it's crazy to think that that was the world we live in. So are we in a new regime? I don't think we're in a new regime. I think we're in a more normalized regime. And, I know some people are calling new normal. I don't think there's such thing. I think there's so many parallels to the 2000 period, right? You got a credit boom. The GDP is growing. We're not growing as much because we're on a lower trajectory because of the debt burden and everything. But there's a lot of similarities, yields where they are, credit spreads where they are. And so I feel like this is more of kind of the earlier part of my career than that middle part. And I think it's a better market, right? At least, I know that if I sit in cash today, I'm going to earn 5% plus. Even if the Fed cuts, I'm still going to earn 5%. That's a lot, right? And it's not a lot to, your high octane investor, but where I compare that to, if you go back into like, I think it was, August of 21, that's not that long ago, right? We're talking 3 years ago. The high yield bond market yielded like three and a half, 375. That was yield, not spread. Actually, most of it was spread. They were very similar numbers because the yield was so low. But like, think about that. Today, a T bill yields more than the entire junky part of the bond market back 3 years ago. And so I think that needs to be recognized, and it changes the playbook. It changes the playbook because you don't have to be super aggressive to get, mid to high single digit returns now, right? You don't have to go off the reservation. You don't have to blindly buy pools of assets. You have no idea what's in them. And so I think that the dynamics are better today, but I don't think it's much different than what I would call, at least what I thought of as a typical cycle. And, it begs the question, where are we at this cycle? Look, there's still a lot of liquidity out there, right? We printed a lot of money. You can't expect to give, inject the currency, increase the currency float by $7 trillion and nothing happened, right? It's going to go places. It's going to find levels. It's going to go in the housing market. It's going to go in stocks. It's going to speculate. It's going to buy things. It's going to buy experiences. And so I think that's part of it. And I think the difference here, some of us missed early on, and why there's been these calls for recession for a long period of time, is that I think the Fed transmission mechanisms work. And what I think what a lot of people have missed that I've really started to appreciate is it's not the credit component. Obviously, credit is more expensive, right? You want to borrow money, a house, car, auto, I'm sorry, credit card, student loan, they're higher. Corporate America is paying a higher rate than it was before. But a lot of us have our debt stock financed like mortgages in the 2% range, 3% range, right? So the new rates don't affect us on those purchases, right? So the credit component worked. The Fed was able to achieve that. What hasn't happened is that increased savings component, right? And this is something that I struggled with for the last 18 months of trying to figure out why. And 18 months ago, I just said, well, it's obvious, Alex. You know what the deal is that people don't think their 4.5% cash rate that they're getting is enough to outstrip inflation. So I understand that. You're not going to save because you know what? You can go spend the money because the money's eroding much quicker. But now I'm like, well, inflation's down. Price levels are still elevated, as we all know. We won't accept deflation, so they're going to stay elevated. But why aren't people saving more today? Why don't we see a significant increase in savings rate? Maybe it's because the prices are expensive. Maybe that's what it is. Maybe the other component is people are actually keeping their savings in a savings account and they're getting these basis points. So you know what? They're saying, look, my inflation rate's high. Since the pandemic, my inflation's over 20%. I'm getting basis points. Let's just go take the trip to Italy, right? Let's just go to Disney World, right? Let's pack up the car and go. And so I think there's some of that component where people who don't have that enough literacy to understand this, and it's not their fault. They just haven't been educated on it, right? That they are suffering or they're not being able to take advantage of it, right? And so I think that's part of the transmission mechanism that hasn't applied. I don't think it's broken, but the banking system isn't passing that through unless you ask. And if you don't know to ask, you don't know. And so I think that's part of what's changed in this environment, which has let this kind of economy go on a bit longer and why spending has stayed elevated throughout this cycle. And look, maybe the Fed's engineering a soft landing. Maybe this is a good thing that's happening, that they're going to cut rates and do that because, it's hurting those lower income strata and the lower quality borrowers. It's hurting small business. And so maybe that's why we're doing it. It's not the aggregate they're looking at. They're looking at that targeted area. And so, these are all the kind of things as you kind of zoom out and try to figure out what's going on in the economy is that, look, the consumption data is there and it will be there until people lose their jobs. And so that's the thing to really, I think, for all investors to focus on. And, we got unemployment claims today. They were a little weaker, or there's more claims than we've seen in a while. And so we'll have to see, is this a trend? Or is it something, is it just kind of aberration in the data? I know I went on a long tangent on that, but
That's okay. One thing that you quickly reference is this whole notion of an inverted yield curve, which you've had for 2 years. And that has surprised a lot of economists and investors because when you look backwards, at least for the last 40 years, whenever you've had that, you ended up with a recession, and we haven't had a recession. And I think part of it is what you described with loans getting extended out, but also part of it is the boom was largely fueled by fiscal transfers and sending people checks and spending some of that excess savings. And it'll be interesting to see how long that plays out.
Yeah, I agree with that. And look, I think that again, when I look at it, I look at kind of just the aggregate too on the M2. And if you plot the level of that, we're still way above the trend line because, I mean, we increased the monetary base by like 30 some percent, in 2020 and 21. I mean, it was unreal. It was literally unprecedented, and so from that standpoint, it's got to find a home. And, look, maybe people are looking at the price of their house and going, yeah, I feel okay. I could sell this if I have to. I don't know. I mean, I don't know how often you look at Zillow. I really don't, but I can't imagine people marking to market and going, oh, I'm going to go out to a nice dinner tonight because Zillow says my house is up. But I think there's some of that just going around. And like at the end of the day, I think also our tastes and preferences have changed. And that's what you won't find by looking in a historical data set. That's where you need some experience. You need to know people who've lived through it. Because if you look like through the data set and you just looked over the last 10 years, you'd say, wow, something weird happened in 20. But then, man, they just figured it all out and all got together. But also, I think our behaviors have all changed. Well, not all of us, but in general, I think there's a higher valuation on doing things, right? Or people value that more. And you're seeing that the service data, and we've always been for the last 20 years, we've been a service-based economy, but it's becoming more and more reliant on it. And I think some of that is just the change that we've seen because, again, we locked people down for a while. And so that's the thing that's hard to look at a data set and say, what's happened? So you got to go pull some news clippings, pull some covers of magazines, try to figure out what happened in that era that changed that dynamic. And again, no one can really relate to it unless you've truly experienced it. And so that's the thing that I'm trying to figure out as well is that are we different people now? And the way what we value and what we cherish more, is that driving some of this as well?
And two other things that I think about in terms of surprises that may come in the future. Obviously, always thinking about what we're missing. One is the Fed's reaction function. Now that inflation is a real concern, we haven't really had that problem for a long time. And second is where default rates may go. When you look at default rates in a falling rate environment, that may understate the risk because you can refinance easier and extend your debt. How do you think about those two?
Well, the latter, I think, is something that most of us haven't seen because we'll talk about the 40-year, bull market there, right? The high yield market wasn't invented until we had the bull market, right? I mean, it really took off in the early 80s. And so from thinking about that, it's never really went through this long secular period of 10 years of rising rates, right? And so you're absolutely correct with that. Maybe the default experience, especially as of late, is understated. I think there's another culprit, which is understating default rates today, and it's private credit. And that's been a backstop that if a company is really struggling, you sell your soul to the PE firm or that's going to take you private, take some of your equity away, get some warrants, do all these things. They're going to restructure it for you and let you survive for a period of time. And so I think some of that's happening. We've seen that in the loan market too, where the loans look like they're about to default and they just get pulled into the private market. And so the secular rate rise would be very interesting to see how defaults behave because, the one thing about the post GFC to the pandemic is that we didn't really have a true business cycle. Anytime there was any sort of wobbliness in the economy, it's like we did some form of stimulus, right? A lot of it was monetary and not fiscal, but we did that. And so by repressing rates, and I don't know if I love the financial repression phrase, but I'll use it here. But by keeping rates, let's say, abnormally low or maybe below where they should be, we let companies survive that shouldn't, right? The whole business cycle component is that we have excesses. And so the excesses need to get worked off, and that's through the default cycle. I mean, look, I think if we'd have lived in the, I think if Uber would have came out in the mid 2000s, it probably wouldn't have survived, right? You couldn't have used all this private money to be able to subsidize it to grow and get the base that they needed to do. That same for Lyft as well. Again, no criticism of either of those companies, just that they were able to have cheap financing, access to capital. I mean, look, you can't tell me that it's cheap, that Uber should be cheaper than the taxi, right? It just doesn't make sense. It can't be half the price, right? That there's something wrong with one of the business models somewhere, but it was being subsidized. So I think that the default cycle will look different if we go into these rises, right? And remember, there's still parts of the high yield market that have very low coupon, right? And so they don't want higher rates for that same reason. Most high yield bonds don't ever pay off. Like they get rolled over, right? It's not like they pay down that debt. So I think that's a very important thing to think through to the cycle. And I forgot the first part of the question because I got so obsessed with the high yield part.
No worries. The Fed's reaction function and how they may be different.
I think no one wants zero rates again. I don't think really anybody does, at least from the investors. I don't think the Fed does either. I think what you see the Fed's reaction function in terminal, right? What we call the terminal rate. So you go to the dot plots. The terminal rate just means where does the Fed end up in kind of normal times. It's not where it actually ends in the cycle. It's defined. It's like R star. It's kind of defined to be, what is the rate that's neither contractionary nor expansionary. And so if you look at the dot plots and the long-term estimates that come out of those, they've moved up over the last 5 years, right? And so, or at least over the last 3. And so that I think is that the Fed's reaction function is going to be that, okay, we're still going to get some level of inflation, and it may be a little bit more than our comfort level is. Thus, we need a little bit higher rate. Plus, we need some premium on there to incentivize investment. So I think that's why the kind of terminal rate has went up. But still, I mean, look, will they cut below what is terminal? If they need to, they would. But I do think that that's kind of reflected in those dots. And if you go out and you can go like the Eurodollar market, the SOFR futures market, and look at it, it's kind of what the market has said. The market has gravitated to those dot plots and says that's effectively where we're going. The path may not look the same as the Fed's dots, right? But that's what it says. So I think it just depends, right? If we get inflation, if we're having a recession, they cut rates, and then they see this massive deluge of fiscal stimulus, maybe they do react faster to the other one. So I think we just need to be prepared that if we have a recession and you start to see that response, I think you and I are going to have to react quicker, irrespective of the Fed, and we're to think about kind of the implications there. Because I think Congress realized last time when bad things happen, if we throw a lot of money at it, we're going to get reelected, right? And look, it's just it's a fact of kind of the nature of the job. So
you alluded to this earlier, but one of the ways to get out of your debt problems and your massive fiscal deficit problems is to inflate your way out. And so there is some incentive to have maybe higher inflation than we've seen for the last 30 or 40 years. So based on that, what's your outlook for inflation over the short term and over the long term?
Yeah, well, the Fed has to get us to 2 first, right? Because you can't say we've missed our target, so we're changing the target. Well, you can, right?
You lose some credibility if you do that.
That's the thing. And they need credibility because it's not just the credibility of you and I, it's the credibility of the world. It's the stability of the dollar. It's the treasury market. They have to convey that. So I think there should be an acceptance for a little bit higher level of inflation. Like, Alex, why is price stability defined to be 2% inflation a year? I thought price stability would be 0 inflation, right? I mean, if you really think about it, that's truly price stability. But the problem is that the Fed is worried about deflation. They're always worried about contraction. And to you and I, deflation is a great thing as someone who's going to buy something. But if you're a seller of goods and services, you don't want deflation, right? Because ultimately you have to charge less. And so it's less value to your product, especially if you produced it earlier. So there's this weird asymmetry within kind of how the Fed has to think about things. And so deflation's evil. 2% inflation is like optimal. But 3, is it really that evil? I don't think so. And I like to remind people that before the financial crisis, and we all kind of, lived through it, know what happened there. But if you go back to the inflation rate back in like '06 and '07, they were between 3 and 4%. You're like, no, no way, you're crazy. No, they were. We didn't explicitly target these 2% inflation numbers, right? It's something that was created along the way. And so there's this dynamic of like, this is how we've always done it. The answer is no. And some level of inflation is good, but the problem is it's a regressive tax. And the problem is that you hurt the lower income strata, you hurt the impoverished, it hits them the most because inflation, if it's rampant and it's everywhere, they get penalized the most. A billionaire doesn't care about inflation. Well, they're going to tell you they do. They're going to complain about it, but they're still going to consume the way they consume. I've had this debate. Well, two, three, does it really matter? And, over 10 years, it does, right? Because that purchasing power erodes a lot quicker. So, I think that we've seen a different dynamic. I feel that we will have higher levels of inflation than we had during that GFC to pandemic period, but I don't know if it's going to be rampant. I think it's just maybe that maybe we value a worker better. Maybe we have an appreciation for that lower income strata, and we say we need to get them more things so they can consume more. Remember, the economy did pretty damn well when we create all that inflation. Now you didn't feel like it, but asset prices did well. People were going out, people were buying things. And so, again, there's got to be a happy medium in there. It can't be living on the extrema. But I do think that, we could see a higher level of inflation to a cycle because we have seen it. And we say, you know what, 2.5, 3, it's really not that big a deal. And again, I understand it is regressive. And I know I've said that multiple times, but I just feel that, the Fed can't change it. And I actually think that why does the central bank target an inflation rate? And I know it's that we're trying to bring price stability, you're trying to help everybody out. But I think the next kind of Fed review, I think the idea that's going to be floated the next time is nominal GDP targeting. We want to get to 6, right? 6, because we grow nominally, right? We got to grow our way out of this. So if we target 6, now there's nothing that says we'll achieve it. Does it matter if it's, 3.5 real, 2.5 inflation, or 3 real, 3 inflation? Probably not that much different, right? But if we're so obsessed with that 2% number and the 2.5 is just way too much, well, maybe then we stimulate, it's just inefficient use of capital. So it's hard to see what it looks like. And I think we're going to have to see how our fiscal authorities behave and can they rein it in? And if they can't rein it in, then I think we're probably going back to a little bit of a higher inflation rate than we even have today.
One question that I had is how you think about today's just general environment relative to the 1970s, particularly this notion that inflation is going to come back down towards that 2 to 3% target. It is pretty fascinating when you look at inflation jumped to 9% plus, yet nobody expected it to stay there. The market's always pricing it to come back down. And so how is that related to what we experienced in the 70s where it continued to surprise to the upside?
Yeah, well, you had the wage price spiral there. You didn't really have it in this instance, and this is why I put a slide like this in my last webcast I did a few weeks ago, where and again, I'll admit I cherry picked the date, and I did it because I was trying to tell a story, and I put it from June of 2020 through current, and I showed CPI and I showed average hourly earnings, and they're essentially neck and neck, right? CPI is a little bit higher. If I was a politician, I'd say, well, there you go. That's why the economy stinks, right? But the reason I didn't use just early, like let's say December of 19, was because during the pandemic, average hourly earnings spiked in March, and it's like, wait, all these people lost their jobs. How did earnings go up? Well, the bottom income cohorts dropped out, right? They're the ones that couldn't work, where the the white collar worker was still getting paid. So it distorted the mix of it. So that's why I kind of chose that date. But if you kind of think about it, during that 70s experience, wages were continuing to go up somewhat commensurate with inflation at that time. And so I think what's happened in this market is that we haven't really succumbed meaningfully to that wage price spiral. I think at first the big 9% inflation number you got was goods, right? There was truly supply chains, not supply side, but the supply chains, the lack of being able to find things. I mean, look at auto prices, look at appliances, look at delivery time. Everything was a disaster. And then once we open back up, the excess savings, the stimulus, all the checks everybody got were then put to work in other things, right? It's like, let's go spend. So services came up, but also housing is the big piece there. And so I think that's what most people saw in the inflation data is that it's owner's equivalent rent. That is the kind of shorthand for saying rents and kind of housing in general. And that number should roll over eventually, right? And so I think that is the difference. It's where the inflation's coming from. And the 70s, it was significantly more focused on goods, and you had this wage price spiral. And you're not really seeing that in today's market. So I think that's the differences here and why the market has been much more sanguine and confident about that coming down. I don't remember the peak in 10-year break evens, but I want to say it was like 325. It was like a three handle, even when we were at 9% inflation, right? Because it was not the belief that we would get there. I think 2 years got to like the 2 year break even got to like 4% during that period. But now they're all just coiled around this kind of 2.25 to 240 number. And so I think the reason is that you look at the components of it, it's a different level of inflation. Also, we're not dealing with an oil price problem, right? That's what's kind of missing from this one as well, too, is that this inflation wasn't commodity driven. In early '08, we had a lot of inflation. Why? Oil price hit $150 a barrel, 42 gallons, right? So they hit a barrel. That was in June of '08, right as we were in the precipice of a recession, right? And a lot of times recessions are caused by oil price spikes, right? And that's a big difference, I think, about this market too. Prices have been relatively well contained in the oil market. And I think some of that, even with geopolitical tensions that we've had for a long period of time, oil hasn't really responded to most of those. And I think a lot of it is because the US is a big producer now, right? And we're an exporter and we've balanced that supply out. So back to your balance of risk and think about portfolio, I think the oil market's more balanced that way as well. So I do think they're different.
DoubleLine launched just after the GFC. And at that time, you found many amazing opportunities. Since then, you've had a pretty benign credit environment. Do you generally think that it's harder to find great trades in that environment? And how do you see that evolving?
Yeah, no, it is harder. It's meaningfully harder because, when everybody's happy, spreads are tight. When everybody's scared, that's when it's the best time to buy, right? And so, it's definitely a tighter time right now. The difference in that period of time in late '09, early 10 was that, the mortgage market was so roiled at that point, and investors had zero confidence in it. They saw how bad it went down. They wouldn't believe your analytical framework. They wouldn't believe that these bonds would ever return, any of the money that you put into them at 40 cents on the dollar, right? And they were completely analyzable. And so, and there was ways of balancing that out. So when you get a dislocated market, there are things you can do. The problem is that they're not popular, and that's why the market gets dislocated. And look, there's a lot of smart people that made a lot of money at that point in time, and there were very obvious things to do. I remember a few years ago going back and I was cleaning out my inbox and I had all these archives. I'm like, why do I have this stuff archived? And I went to the archives and I was sending out emails to people saying, look, we can build you this customized portfolio to conservative subs, and it yields like 10. Like, look, in a bad thing, here's kind of scenario analysis. They're like, I don't know. It's got too many mortgages and I don't like it, like, oh man, to live in those days again, right? But I think, there will be another opportunity. I think the commercial real estate market will, I don't know if it'll experience a similar thing that the Resi did back in that period of time, but we're not anywhere near the bottom in that market yet. We haven't even seen, buildings come out and be available. So I think there will be some very good opportunities. And look, they'll be in the public market. Some of those deals will happen. A lot of them will happen in the private market. But In today's environment where spreads are tighter, they're tight for a reason. They're tight because the economy's done okay, the companies are generating cash flows. And by the way, the debt service coverage is high because their coupons are low. Now, does that mean that that company is great for the next 20 years? No, that company is great until the bonds roll over, right? And then we'll have to figure it out. So I think it's trying to think to that. And so what like our below investment grade team on corporate bonds is doing today is saying, okay, do I want to own a loan? If I have a loan and a bond, what do I want to own? And like, do I think this company can make it through the cycle? Right. And that is an important thing to think through as an investor. It's like, okay, if we have a downturn, what happens to this business? And so I think today's market is a little bit more idiosyncratic, is where the good ideas are. The on the run stuff, everybody knows it, everybody's well trafficked in it. And those things are tight, and they're tight for a reason. Lending to Microsoft or Amazon, you're not going to probably lose money on that, right? They're going to pay you back, but you're not going to get a lot of money for it. So I think you have to be patient. And that's another thing, is that, I learned a long time that you can't force trades. You can't force into market. Sometimes you have to buy in a market. Alex, you guys send us $100 million. We've got to spend it. That's our job. We have a prospectus. We have a mandate. We have to buy it, but we have to exercise discretion in doing so. And so I think it's very important to say you shouldn't get more bullish just because prices are up, right? A lot of times in bonds, you should actually kind of think a little bit the other way. But just because prices went up doesn't mean you should get negative either. And so I think what you see in the opportunity set, it's waiting for it to develop. Last year was a great time to invest in fixed income. And then we had this big challenge of we backloaded our returns all last year in the last 2 months, and the yields got low. And so it was a rough start to the year. But returns have been good. If you look at a 2-year return on fixed income, it's pretty good, right? And so I think it's being patient, it's being diligent, but it's not just reaching. And that's where you get in trouble. And that's the whole blow up path. If you can manage the risk and be good enough, I think today's market's a good enough market. It's not the risk seekers market. And so I hope there's going to be a time we can talk, and it is the risk seekers market. And look, last summer was pretty good. Like or in the fall, I should say. Like September and October, the phone was ringing off the hook. The emails were flying. People wanted to put stuff together. And look, you want to take risk. We could have built you a below investment grade portfolio in the 11, 12 range easy and felt comfortable with it, right? Yeah, because spreads were wide. 10-year was at like near 5, right? There was this opportunity set, and the institutional community was out there. They were rampant. And then we got the rally, and everybody's like, well, I don't know anymore, right? And that's kind of where we are right now. And it's like, I'll just wait. But if you're waiting, you need to be calculated on how you do it, and you have to have a plan. And right now, the plan is to figure out, is the labor market cracking? And if so, you want to own more rates probably than most people own today. And if it's not, then there's nothing wrong with owning that tight spread product. And guess what? I don't know which one it is, Alex, right now. I can't, I have an inclination that's probably where I'm more sanguine than I'm pessimistic. But you know what? I can buy both sides. I'll dilute your return down a little bit. But you know what? I'll feel very comfortable about doing it. And it's better than indexing the product, right? So that's how I'm thinking about today's market.
And let me ask you quickly about the Fed. So COVID hit and they threw the kitchen sink at the problem. With hindsight, it seems obvious they were too stimulative for too long. Then we had the highest inflation in 40 years and they aggressively tightened. What's next?
They're going to cut. They're going to get back to kind of normalized rates. Jay told you, for the last few meetings, he said it that last summer, he's like, they were tight. They're intentionally tight. Now he thought they were overly tight, right? So he's setting it up for the cut. He's probably going to deliver a cut. The market thinks they're cutting each of the 3 meetings at this point for the rest of the year. And I don't know. It seems a little aggressive to me. I feel like they want to step into it. I feel like they want to go like the quarterly cutting cycle just to wait and see a little bit. And they accelerate if they need to accelerate it. But the next path is to cut rates, and they're going to do it. Is it 100 over the next year? Is it 150? I don't know. They'd have to cut it every meeting to get close to that 150. I kind of feel like it's more quarterly right now because they don't want to start to do that. Asset prices stimulate. that leads to people wanting to spend more money. If the wealth effect does exist, I'm on the fence about that. I'm not really convinced it does. But if that's the case and inflation takes off, then they have to hike again, right? So I think they want to be patient. The good news, why I think that too, is that they've been patient. They had to hike quickly because they were way behind. People have been calling for cuts. Have been calling for cuts for a year, right? I mean, the market's dead. The economy's dead. Economy still did pretty well in the second quarter from what I just saw in the first release. So I think that the idea here is I think the market's a little aggressive in thinking they're going to cut as quickly as they are. And I don't think they have to just get completely back to neutral. I think they can have a glide path. It doesn't need to be every meeting. But maybe they do the every meeting just to get us there quicker and then hit the brakes, right? And we'll have to wait and see. But as an investor, does it really matter if they cut 100 over a year or 100 in like 6 months? If that's where we're going, the market will sniff that out one way or the other. And so does it change the economy? No. Does it change the dynamics of some of the floaters? Of course. But you can blend this all together and, put some floaters in there, put some fixed rate asset in there, have some rate exposure, have some more like exotic credit exposure in there. And all of them mixed together, things will work in all those environments. It's just that if the Fed's slow to respond and they ignore the signs from the labor market, if that's what's deteriorating, that's when we have the problem. Because they're now talking about the labor market and they're talking about a little bit of weakness there. And remember, the beige book is what they're talking about. Jay talks to lots of business leaders around the country. And I think that's the thing to focus on. It's not inflation anymore. It's the labor market and how robust is it? And the bond market seems to think it's not a problem, that, everything's moderating and we'll have to wait and see. But I do think that the Fed will start to cut. They're going to bring those rate cuts through 25, and just where they end, I'm not convinced yet, because I think it also depends on the outcome of the election, right? And that's going to dictate something because the policies will be pretty different depending on the outcome there. And I think that's something that, we can all have our own crystal ball and everything. But look, there's a scenario where you get a sweep from one side and all of a sudden now you're jamming policies down, that the whole dynamic changes. And so that's something that has to be in the back of investors' mind right now. And that's why we're like, well, what do they do in 25? I say, let me get through the first Tuesday in November. Well, hopefully we know Tuesday night. Hopefully it doesn't take us a week plus like the last time. I guess that's still quicker than the Bush election, right? Back in what was that, 04, right? And we'll have to see what happens, and so that's why I want to pause through a little bit of this, because there could be something extreme that comes out of that, and an investor needs to think through that. And I don't like to reverse trades. I don't like to have something on and then have to change it. I like to build things that can go over longer periods of time, and that's just the discipline we try to bring.
This is great. Jeffrey, I've known you for over a decade, and you've always had infinite energy, which was on full display today. But I know your time is finite, so I appreciate you spending about an hour and a half with us, sharing your insights. Thank you.
Yeah, great to be here, Alex. As always, it's a pleasure talking to you. And as usual, I enjoy the conversation. Usually I'm asking the questions. A lot of times in our reviews, it's me giving you this energy, but it's great to share it with your listeners. And thanks for having me on the podcast today.
Thanks for listening. We hope you enjoyed this episode. Please visit our website at insightfulinvestor.org to access past shows and learn more about our podcast. If you have questions, feel free to email us at info@insightfulinvestor.org. And if you enjoyed the discussion, please subscribe to this podcast to ensure you don't miss future episodes. And don't forget to forward today's conversation to others you think would enjoy listening. This podcast is provided for informational purposes only and should not be relied upon as legal, business, investment, or tax advice. All opinions expressed by podcast participants are solely their own opinions and do not necessarily reflect the opinions of Evoke Advisors, their affiliates, or companies featured. Due to industry regulations, participants on this podcast are instructed not to make specific trade recommendations nor reference past or potential profits. And listeners are reminded that securities trading, commodity trading, and alternative investments are complex and carry a risk of substantial losses. As such, they are not suitable for all investors. Listeners should be aware that guests featured on The Insightful Investor may have current or past associations with Evoke Advisors or the host, including as an investment manager of a private fund opportunity by Evoke, or access through an affiliated Evoke fund, or as a client. Participation as a guest on the podcast should not be perceived as an endorsement or testimonial with respect to Evoke Advisors, the podcast host, or their services. Similarly, the inclusion of a guest on the podcast does not imply that Evoke Advisors or the host endorses the guest or any company with which they may be affiliated or employed. Evoke has neither paid nor received compensation from guests for their participation.